Hello everyone, today is March 20, 2020. In the recent 2 days, Thursday and Friday today, the market finally calmed down a little bit. At least it's not moving that dramatically or wild as the previous 2 weeks. We can consider, a little bit pullback is equal to a small gain, and no circuit breaker to be triggered will be considered as a very good news. Most people will have the intuition that, after so dramatic swing of the market, finally it probably will be calmed down a little bit. It's just like the thunderstorm, a huge wind, they cannot last long. And who did that? Is the heaven, the nature, and even the nature cannot have a really long, prolonged thunderstorm. No matter who you are, we are human beings. We cannot outdo the nature, right? And I want to thank you everyone for taking your time, paying attention to this video. I got a lot of attention and question as well. I got a few questions. The consensus questions are 3. But number 1 is most people will ask, the U.S. economy, the real economy looks pretty strong, especially the employment rates are so good. And the capital rate in the financial system is also very nice, much better than 2008. Why we are seeing such a huge crash of the market? Well, the second question is, we are seeing so dramatic action from the Federal Reserve, one after one. They doing another QE and providing $1.5 trillion of liquidity to the market. Do they still have any ammunition in their tool set? And if yes, what is in their tool set? They are all very good questions and definitely worth of a lot of discussion. But today, I want to leave the 2 very important questions aside a little bit and talk about another one, got a lot of attention from many of you. And that is, when we are seeing a market crash like this, should we buy the dip? Is that the bottom? There are so many people are asking me about that, so I want to at least touch on that, and we can have a discussion. I will share you my opinion on that. It's really not an easy question, very challenging, because investment is a game of probability. And the reason I decided to talk is I found an article, an article talking about this buying the dip. I was published the day before yesterday. The author of the article is from one of the most famous hedge funds, RitholtzWealth Management. And that analyst's name is Nick Maggiulli. This Ritholtz hedge fund is so famous because the founder and one of the principal investors is Barry Ritholtz. He is in charge of the Bloomberg View channel. So he interviewed a lot of big guns on Wall Street, and is pretty famous and has a lot of impact on the Wall Street. So this article coming from his Ritholtz hedge fund is an interesting one. It's an interesting piece I want to share. The title essentially says it all. The title is, should you buy stocks now? Should we buy the dip? It's very straightforward. The article is not an academic article, so it's pretty readable, but it's a little bit long. So let me summarize his main idea and opinion. Hopefully that will give you some insight. And I will share the link of the article as well, so you can go to read it yourself. In short, the main idea for Nick is not complicated at all. It was essentially one of the most famous saying on the street. The time to buy is when there's blood in the street. So when there's a lot of blood flowing on the street, this is the time. And this is also consistent with Warren Buffett's idea. He said, I will tell you how to become rich. Close the door. Be fearful when others are greedy, and be greedy when others are fearful. So if you want to know how to be rich, be silent, don't tell anyone. Essentially, it boils down to the two driving factors of the market, fear and greedy. But you have to be greedy when others are fearful, and you have to be fearful when others are greedy, right? When there are blood on the streets, everyone is fearful, you should be greedy. Well, it's much easier to be said than done. The problem is how to implement it, right? How do you quantify the fear? And in this article, Nick pointed out that we can probably use the fear index, VIX, as a way to guide our action. Now, let me very briefly explain what is the fear index. The fear index, VIX, the full name for that is Chicago Board Options Exchange Volatility Index. So in short, the abbreviation people often call that the VIX, or the nickname for that is the fear index. The way it was calculated is the implied volatility for SP 500 option for the following 30 days. So essentially, that was the implied annualized volatility. Although the calculation for the VIX is still pretty complicated. You have to know Black-Scholes model, you have to know different horizon, maturity of options, and do the weighted average is pretty complicated. But what we need to know now is the VIX essentially giving you a expectation for the following 30 days volatility. When the market crash, of course, the fear index and the VIX will goes up. When the market calm down, the fear index will also calm down following that. Since 1990, that's the starting point of the VIX index. In the past 30 years, including the 2000s internet bubble, including the 2008 financial crisis, including the current the market crash, in that 30 years, the average VIX index is 40, about 40. So in this article, Nick used 40, the 30-year average VIX, as the indicator, and he examined what if we buy the dip when the VIX index reached 40 or above. In that 30 years, there are 8 times the VIX index surpassed 40, from the calm period going to the panic period. If you buy from now on, in the following 1 month, the average annualized return is 5%. The average half-year return is 14%. The average 1-year return is 32%. If you go even longer, the average 3-year return will become 16%. And that is because when you are going longer than 1 year, the market will finally come down and cannot provide a very high actual return for a longer period of time. So now, the fear index has been reaching the all-time high on March 18, 2020. Is higher than the peak of the 2008 financial crisis. Even yesterday and today, when the VIX index goes down a little bit, it's still at much higher level than 40, right? So once you know that, did you feel, warm up and ready to get into the market and buy the dip? Be patient and wait a little bit. Let's finish the reading of this article. Previously, we said all of that return is average return, but average is pretty misleading. It's kind of like if I average the wealth of me and Warren Buffett. So both of us will, on average, be a billionaire. And however, we all know that it's only Warren. He is a billionaire and average me up. So average itself may be misleading and confusing. What about the worst case scenario? In this article, and this is what I like it also examined if you buy at the dip at different panic level, what will be the worst case scenario in the following period of time. And his result shows that if you buy the dip when the panic or the fear index is lower than 20, when the market is not panic, not fearful at all, the worst case scenario for the following 1 year is negative 44%. Is a disaster. The worst average 3-year return is negative 17%. It's still pretty bad. But when the fear index is higher than 40 and you are buying the dip, the worst case following 1 year return is negative 13%, and the worst case following 3 year return is 2%, become positive. It's not great, but at least it's a positive one. And at the end of the article, it points out a few things. Number one is, well, this time may be different because this time is an overlap of a kind of a technical crash plus a fundamental crash caused by the coronavirus. So it's very different from what we were seeing in 1987 and probably 1929. So all of the historical data may not be reliable. It's just like what's that, history doesn't repeat itself, but it often rhymes. So it probably will rhyme, but it will not repeat. So be careful about using the history to imply the future. Another thing is, this type of market is not for everyone, especially if you are a beginner in the market. If you don't know too much about the market, this is not the time to try to catch the falling knife. And he said in the article, if you don't know who you are, this is an expensive place to find out. If you don't know what you know, and you don't know what you do not know, the tuition will be very, very high in the market. You either find out that you are a genius, you can time the market perfectly, you buy the dip and then goes up, you sell at the top. Or it could be a disaster. You will realize there could be lower low. This is low, but there could be lower low, and there could be lower than the lower low, right? So never call the bottom. No one can call the bottom. As long as you don't have a strong heart and a strong mind, you have to be very, very careful before going into this type of market. Well, that's all for today. Thanks for your time and attention. I'll see you next time.